Missing my stylus pen. Oh, good. All right. So, introduction to partnership accounting. Any questions on this? Again, you guys, next class, I have no problem going through and starting off reviewing material we covered tonight because it's so important. Introduction to partnership accounting. This is going to come up big time when we deal with allocations, okay? So this is just a taste. One of the things that you're going to hear throughout this course is you got to maintain capital accounts. Maintain capital accounts. This is not a tax concept. This is more of an accounting concept, okay? So, and this is not spelled out directly in the code. It is spelled out in the regulations. If you look on page 41, the authors direct your attention to the regulations. Now, in partnership tax, guys, the regulations are not easy to find. So my recommendation, when the authors tell you to go to regulation 704, okay, and it's an exam and you want to find a particular regulation, my humble opinion is at the very top of the regulation. Your regulation book only has 704-1B2. I have taken liberties in my own regulation book to put 4 little I, A through B, just to find myself. And at the top, 4 little I, C through D. And then on the next page, E and F. Because the regulations are very, very detailed. And trying to find yourself in these regulations is not for the faint of heart. So you may, your choice, guys, consider putting the numbers at the top of the page. All right, so introduction to partnership accounting. What the authors do is they're going to walk through, based on these regulations, which hopefully everyone has read, but if you haven't, that's what Labor Day weekend is all about, is to read these regulations. Do not, I emphasize, do not think you can get through partnership tax by just looking at the statute, guys. It is a non-starter. You will not succeed. Okay? So what the authors are going to do is they're going to walk you through the example using these regulations of people forming a partnership. And beginning on page 42, they're going to talk about the contributions, and they're going to talk about the capital accounts. And let me just make clear, what does your capital account represent for your client? It represents their economic stake in the partnership. Let me repeat that. A capital account represents an economic stake. It is a very valuable number. At the end of the day, it represents what they can take out of the partnership. If everything falls apart, that's the number, the go-to number that they can take out of the partnership. It represents their economic stake. So partners should have particular interest in what is their capital account. So the authors walk through this problem. They talk about the contribution on page 42 of this property. They show the capital accounts in both the hands of the partnership and the hands of the partner. They talk about, just like we did before in this prior problem, page 43, what is the adjusted basis of the property? Okay, just again, very similar to what we had in the prior problems. Turning the page. On page 44, I believe on this page the partnership made a profit. They split the profits, and that's how we got, notice how the capital account, by the way, when a partnership makes profits, the capital accounts go up, and we will see under code section 705, the outside basis, not the inside. The outside basis goes up. When a partnership makes money, the partner's outside tax basis goes up. It goes up, and when distributions are made, guess what? The partnership basis goes down, right? That makes sense? So that's why when a partnership makes money, even if you don't get a distribution, you get taxed, right? You get a K-1 that reflects your proportionate share of the income. Your basis goes up. If you get a distribution, your basis goes correspondingly down. Doesn't mean you're taxed. It will just absorb part of your outside tax basis. Now, what you will see is that when a partnership incurs a liability, beginning on page 45, when a partnership incurs a liability, one of the most important things, and we're going to be looking at this shortly, is the liability recourse or non-recourse? Because very different rules apply depending if the liability is recourse versus non-recourse. So typically, when I'm reading through the book, I will circle the word recourse, I will circle the word non-recourse. For exam purposes, can't hurt for you to do the same. Is he asking a question about recourse or non-recourse liability? Because the implications are vastly different depending on which it is. You'll see that if it's recourse, regulation 752-2 applies. If it's non-recourse, regulation 752-3 applies. If it's if it's recourse, the real issue when it's recourse is if the partnership had zero value, who would be stuck paying the liability? Recourse means it's recourse to the partners. Okay, recourse means it's recourse to the partners. The liability is going to be split for basis purposes under 752 based on the amount of the loss the partner would incur. By way of contrast, if it's non-recourse, I'm oversimplifying it, it's based on profitability. Okay, you split the liability based on the profitability of the partnership enterprise. So if three of you split profits 40, 30, and 30, if I did my math right, then that's how you're going to split up the liability. Okay? And for some of you who haven't had a chance to read tonight, I'm talking in the ether, right? You're having a hard time listening to me because this is tough stuff. You really got to read before class, and even then, it's going to be tough stuff. All right? But if you don't read before class, you're really going to be lost. Code section 752 is something we're going to be focusing intently on. The authors are just giving you a small taste here because contributed property can be subject to liabilities. You had a question? Just say it loudly, guys. You've got to talk loudly. Okay. Pretend I'm your spouse. Talk loudly.
For the non-recourse, can
I like to. You could be my spouse because the way you're talking. Now loudly.
For the non-recourse, can that be applied to like a general partner?
Yeah, I mean a general partnership can, if it's lucky, secure a non-recourse liability. Now, most banks aren't happy to, give non-recourse liability. I'm going to say this tongue-in-cheek. If you're Donald Trump, maybe you can say, "Gee, I'm going to not take this loan unless you give it to me non-recourse." But us mere mortals, most banks are going to require recourse liability. All right?
Can you repeat how you split the recourse?
The recourse is based on how the losses would be shared.
And it's different than the profit.
The non-recourse is based on how profits would be shared. Yes, there could be a difference, Chrissy.
Depends on the partnership agreement.
Depends on the partnership agreement. The one thing, and this is where students get sometimes lost, not you guys, is that when it comes to liabilities affect outside tax bases, okay? I repeat, liabilities under code section 752 will cause an adjustment in the outside tax basis. They will not, emphasis on the word not, have any bearing on your capital account, right? Because if your partnership incurs a liability, does that increase your economic stake in the enterprise? No, right? If your partnership borrows money, does that increase your stake or decrease your stake in the enterprise? You borrow $30,000, just means there's $30,000 more cash or other assets on the other side of the ledger sheet, right? Does your capital account go up or down? No. So sometimes students conflate the concepts, but not you guys. Different, right? A liability affects your outside basis, that's the basis you have in this piece of paper known as your membership interest, has no bearing on your capital account. Right, so that's the point on page 45. The authors point out on page 46 a distribution. Distribution will reduce capital accounts. It will reduce your tax basis. And then the most important thing is when a partnership is liquidated, if capital accounts have been properly maintained, the partners should each get what's in their capital account, okay? That represents their economic state, and at the end of the day, that's what they're entitled to, right? All right, so we're gonna be looking a lot at capital accounts. We're gonna be looking a lot at inside tax basis and outside tax basis. So let's see if you really, I know a lot of people are nodding. I hope they're not nodding asleep. They're just nodding because they're getting some general idea of what I'm talking about. Let's look at page 47. And let's look at this problem at the bottom of page 47. We have three partners or equal general partners in ABC partnership. On formation of the partnership, A contributes $50,000, B contributes land parcel 1 with a basis of 40, fair market value of 50, and C contributes securities with a basis and fair market value of 50. Does that look to you, pause, economically, are these three look like they're equal partners, guys?
Yeah.
Yeah, right? Prepare the partnership's opening balance sheet and then reconstruct the sheet for each of the following cumulative subsequent events. So take 1 minute. Let's see. If you get it wrong, you get it wrong. It's not a test, but pretend a word test. Write a balance sheet right now, guys. Take 1 minute. Put together a balance sheet with these three contributions. And let's see if your balance sheet looks like my balance sheet. Everyone have their balance sheet? So we have our assets.
Yep.
So you guys should have cash, parcel 1, securities, and the capital account. We have adjusted basis, fair market or book value, and that's 50, 50, 40, 50, we're talking about inside basis here, the inside basis. Securities 50, 50. A, B, and C, this is their outside basis, right? Elijah, you got that? Outside basis now, right?
Which one's outside basis?
A, B, and C.
Okay.
I don't know, that didn't sound convincing. So this is what everyone wrote, right? Anyone have a problem? Anyone think that I'm just pulling these numbers out of thin air? Time, you had that perplexed look. You good? All right. Anyone else having any problems? All right. Now, what happens? Question A. Partnership leases parcel 1 for $15,000, sells the securities for $50,000. Okay? You want to write a new balance sheet quickly? What would the balance sheet look like? Quickly. Write it out. So if the partnership, we had 3 equal partners and it rents out the property for $15,000, there's $15,000 worth of profit. Everyone agree? They sell the securities. Any gain or loss? None, right? Everyone agree? So in question A, we have assets, asset basis, fair market value, cash, parcel 1. Cash is 115. Fair market value 115. 40, 50, right? They got cash of an additional 65,000 of cash, right? Securities of 50,000 plus the rental of 15,000. I'm giving a signal. Sophia, thank you for coming. Just a quick question. They can't see me now. They can see the board. They can hear me, but they can't see. At the beginning of class, they could see me.
Right, because we're sharing this now. We're not sharing you.
That's good, okay? I just want to make, there was no easy way. At the beginning of class, they could see.
Right, because we weren't sharing.
Okay, once we share this, there's no visual.
Right.
Okay, leave it at
That's
that. I said it's a good thing. They don't need to see.
Can they see this? Can you see this?
I don't know. They can see the board, absolutely.
Okay, okay.
They can see the board.
Okay.
Okay, you have a good night.
You too.
Thank you for stopping by.
No problem.
Okay, so guys, the capital account here, we still have 3 partners, right? And what happens to their outside basis? Increased by how much? 5,000. Code section 705. It goes up by 5,000, right? So it becomes 55, 45, 55. And the fair market value of their interest or their capital accounts is 55 each. Everyone's smiling, everyone see that. Anyone just think, my language is a little punchy up there, where the hell did he get those numbers? Anyone saying that to yourself? Whispering it under your breath? Elijah?
I'm just trying to understand and make sure I follow along right. So you added the premature sold the land, but
No, he sold the securities.
so he leased the land for 15,000.
Stop with the word he. It's the partnership, right? I don't mean to give you a hard time, but words are gonna be very important in this class, right, guys? So we have to be careful, because otherwise people are gonna get confused. So it's the partnership that's leasing the property. So keep going, what's your question?
Alright, so the partnership they leased land.
No, not they, it.
Partnership leased land for 15,000.
Yep.
And then they sell it.
You can't use they, it's a single, the partnership, it. Don't use the word they, because then people are gonna think the partner sold. And I'm not trying to give anyone a hard time, but language is so important because you're gonna throw yourself off. If you don't throw yourself off, you're gonna throw the client off. So this class, English is more important than any English class you ever sat in. And if I give you a hard time, it's not purposeful, it's because if I don't, and the client does, I don't want to see you lose a client. I don't want to see you make a mistake. So I'm going to stop you. So Elijah, keep going, but be very careful about your use of English.
Alright. So the partnership leased land for 15,000, and the partnership also sells it for 50,000.
Sells the securities for
Sells the
50.
security for 50,000.
Right.
And that's added to.
That's 65,000 plus 50,000 of the cash. 50,000 plus 65 equals 115.
Okay.
All right?
Professor, we have something in Webex, I'm not sure
What did I
what.
do?
Webex, it's blinking.
It's blinking. I don't know what that means.
It's blinking, it's
It is blinking, but
If you
that
click on it,
doesn't.
just click on it, let's see what happens.
Let's see what happens.
That's mine.
I would rather see the board, please.
So now
Yeah.
he sees you, he doesn't see the board. See the on the bottom, see the
Yeah,
screen? That's
on
what
the
he
bottom
sees.
right.
Okay. He does see the screen. So I had to go back, I think, and again, I can't blame anyone for what I think I go up to here.
Yeah.
For the job.
Yeah.
Why is this? I'm hovering.
You can go back to Webex and share my screen.
Okay, I'm gonna go back to
And you
WebEx.
go all the way up. And you have it right there on the bottom too.
Where do you see I have it on the bottom? Here?
Yes.
Share contents and select which one. So, yep, that's the one. Share. That's it.
Okay, guys. I think we should be good. Thank you for calling that to my attention. Seriously. All right, if you see it again, let me know. All right, WebEx folks, you should be in good shape. All right, question B, unless Peter, you had a question? No, you're just holding your hand.
All I was gonna say was, even though it has.
Just say it loudly, Peter.
Even though it has no bearing, it would have been all right to say security 00 on book value as well as, adjusted basis. I mean, you didn't do anything.
I mean, we sold it, there's no gain, but let's just keep the facts as is.
Yeah.
All right, question B, the partnership borrows $300,000 and buys more land, parcel 2 for $330,000. All right, guys, you feeling game? Put together a new balance sheet. Take 2 minutes. Better to get it wrong and try and learn than not do it at all. Take 2 minutes. New balance sheet.
So,
Which numbers we keep?
Is it cumulative or?
It's cumulative.
Okay.
Cumulative. Try it yourself. I'm not going to write things down, but I'm just going to outline this. I'm going to go to a new screen because otherwise. have 30 more seconds, write it out. All right, so what happens to cash, guys? Decrease to what?
By 30,000 to 20,000?
It decreases by 30,000, right? They had to use 30,000, so it went down to 85,000, right? Because they borrowed 300, they bought property for 330, so cash has to go down by 30, right? Everyone can handle the math. Okay? Parcel 1 stays stagnant, right? Parcel 2, 330, 330, right? Why? Code section 1012, it gets a cost basis, right? Liabilities, easy. Borrow 300,000, right? And we're told it borrows 300,000. For our purposes, they share profits and losses equally. So, what are we going to do with respect to their basis in the property as a result of taking this liability? Now, not their capital account. I'm talking about their outside tax basis. If you recall, before their outside tax basis was 55, 45, and 55. What happens here? Under Code Section 752, whether it be non-recourse or recourse, it's going to be split equally. Their tax basis will go up by 100. So their tax basis here is 155, 145, 155. And the result here is supposed to replicate what, if you guys remember the Crane decision, the famous Crane decision? If you go and you have to buy a building for your business, right? And you don't put down $1, but you borrow $100,000, right, to build a building. Under Crane, what is your basis in the building? You borrowed all 100,000.
Yes, yours, 100,000.
Say again.
100,000.
Your basis is 100,000 under Crane. Everyone agree? Right? That's true here. In other words, that's what Code Section 752 is supposed to replicate. That the basis, outside basis here, would go up, in this case, proportionally. What happens to capital accounts here? Stays the same. All right? Right? Because, as I said to you before, liabilities do not impact capital accounts at all. So question B, there's your answer.
Are these answers provided in any other book?
No, this is, you got it from me, JB. All right, question C. Partnership distributes $20,000 to A, B, and C. Okay? Partnership distributes $20,000. Take 1 minute, just write out a new balance sheet. Right? What happens as a result of distributing 20,000? Guess what? We have less cash, right? Of 60.
Close to 65.
So it goes to 25. They're giving 20,000 to each.
20,000 each.
Right. Everything else stays the same. The liability remains 300,000, right? A, B, and C, what happened to their capital accounts? It reduces, right? They have a less of an economic stake here, right? What happens to their outside basis? Goes down by 20, right? Because they have less of an investment here. Everyone got this?
Each money is that person capital account?
The capital account goes down by $20,000 apiece because they have less investment in the enterprise, less economic stake. All right?
This distribution is not taxable.
Let's say it loudly, Mina.
This distribution is not taxable to them because it's
Pretend I'm your spouse. You're not saying it loudly enough.
So this distribution is not taxable to them, right?
I have something funny
I'm
about
falling in
that.
love.
I have something funny about that.
What's that? Gabe
As
is a comedian, but okay. V is a comedian when she's not doing tax accounting. So if you ever want, you can look her up on YouTube. She does a great comedy skit. So anyway, V, share your wisdom.
well, this Labor Day weekend, I am going to be in silence as a gift to my husband.
I never thought of that as the perfect birthday present.
Exactly.
Right? So here, for my anniversary, I'm going to give you X days of silence. But it's kind of funny. If you don't mind, that is a female gift to a male. This is going to come across sexist, but I think the women would prefer not the silence, that they would prefer their spouses be more communicative.
Yeah.
So the males in here can give a great gift by saying, look, dear, I'm going to respond to every word you say. I'm going to communicate, tell you things. And the women on the converse side will give days of silence. I don't know. And I'm being taped saying this. All right, we're just having fun. All right, the partnership sells parcel 1 for $65,000, okay? So this is cumulative, guys. Cumulative. So what does that mean if parcel 1 is sold, we're told, for $65,000? We know what the gain is going to be, right? Gain is going to be 25. Everyone going to handle that in code section 1001. Agreed?
Yes.
All right. Now, create a new balance sheet. All right, everyone write down? Take 30 more seconds. Let me just pause for a second. If you recall, under code section 704C, how is this gain allocated? The $25,000 of gain?
First 10,000 to B.
First 10,000 to B, right? Because B should be tagged with the pre-contribution gain, right? So B is going to be tagged for $10,000 for the gain. What's my authority? Code section 704C, right? But here's a regulatory site. It's a mouthful. Well, I'll write it out because you're going to say, what was he talking about? 704-1B2, 4 little i's, D3, and G. There you go. If you look in the regulations, the capital account will not go up in B for the first 10,000 because that first 10,000 was already reflected in problem A. Remember, what was B's capital account on day one? Was it 40,000 or 50,000? It was 50,000. Let me remind you. So the capital count does not go up by this gain. It's already been taken into account. Everyone agree? Just make a based on that regulatory site. B's capital count will not go up by that $10,000. But it does increase B's outside tax basis. Will increase B's outside tax basis under Code Section 705. Ronald?
I'm sorry, can you read that one more time?
Can I repeat what?
What is that 9B?
This is 704-1B2, 4 little i's, D3, and it also, if you look at 4 little i's, G. Okay? 2 different regulatory sites there. That was an ampersand. All right? So, at the end of the day, where does this leave us? Well, the cash is 90,000. Right, because that's what they sold the securities. We're going to increase it by 25 plus. They sold it for 65, so we're up to 90,000 in cash, and parcel 2 stays the same. Okay, the liability here stays the same. What happened to your outside basis? Well, A's will go up by how much? 5,000, right? Because they're each going to have $5,000 of gain allocated to them, and their capital accounts will each go up by 5,000. And I meant to say this is 140, absolutely. I'm glad people are awake. And B's outside basis will go to 140, and C's 140, 140, 420, 420. And life is good. All right, we're good?
So it went up by 5,000.
What did?
The book value went up just by 5,000.
Yeah, because that was, the book gain was only 15,000, right? Originally, the securities were contributed, the fair market value was 50. They're now being sold for 65. So the actual profits of the partnership was only 15. That's why capital accounts are, that's going to be split equally. So 5, 5, and 5. All right, now page 48 begins a much more, now, on one hand, it's much more detailed than what we looked at before. On the other hand, it's nowhere as detailed as it will be later in the semester when we look at liabilities, okay? So, we are looking at this, and we're looking at liabilities today, not in depth, but the authors want everyone in this room to look at this, because when property is contributed, it often is subject to liabilities, right? Partners contribute real estate to a partnership, it's subject to liabilities. And if the partnership assumes the liabilities, generally, that's going to be considered a distribution, right? Now, if there's three partners, Peter, Ken, and I, the three of us, right, form a partnership, and solely contributes property subject to a $30,000 liability. And they agree that we're all going to be mutually on that liability once we contribute into the partnership. I have shed 20 of the $30,000 of liabilities because Peter and Ken are now going to share that, right? So that $20,000 is considered as if a distribution had been made to me. Right? So when you or someone else contributes property to a partnership, as a result of that contribution, you're going to be considered as if there's a distribution to the contributing partner. I know that sounds a little bit oxymoron, where you're making a contribution, but heck, you're getting a distribution at the same time, but that's, as my kids would say, that's the T. All right? So bear that in mind, that every time you make a contribution, unless the partner, Peter, Ken, and I form a partnership, solely agrees, you know what, I'm going to remain liable on all 30. The partnership is not going to pick up that liability, even though I contributed the property, then there will not be a deemed distribution.
Is that per partnership agreement?
Yeah, it's going to be spelled out in the partnership agreement, or we may have to augment the partnership agreement or have an agreement just with respect to this piece of property. Now, again, as you read through this, you're not going to pick up everything, because everything means that you would have to really know everything about partnership liabilities, since we're going to spend a whole class or more on partnership liabilities. But there's some general precepts spelled out here about what is a recourse liability. On page 49, the second full paragraph, the second or third line, it says a partnership liability is recourse liability under 752, to the extent that any partner bears the economic risk of loss associated with the liability. By way of contrast, if no partner bears the economic risk of loss, liability is classified as non-recourse. Generally, whoever bears the economic risk of loss, the liability for basis purpose will be allocated to that person. By way of contrast, with respect to non-recourse, generally that liability will be split based on how the partners share profits. So let's look at this very simple problem on page 50. We have four partners contribute $25,000 to this four-person partnership, which requires $1 million building, paying $100,000 cash, and borrowing $900,000 under non-recourse basis. Okay, I have the word non-recourse underlined, just to remind me. One thing you guys don't realize: this board throws off a lot of heat, so a little warm up. All right, so if the partners are equal partners, what is each partner's outside tax basis? Well, anyone want to say what is the partner's outside tax basis? Carlo, you have any idea? Say again? What is the partner's outside tax basis? You gonna say? Right? 25? Eva, Brian? Is what? 25,000 each?
5,000,
How much?
50 each.
What?
$250,000 each.
250,000 each.
No.
I like your answer. But is it the right answer?
No.
Anna?
No,
Why not?
because it's non-recourse. It's, the partnership is liable for the debt, not the partners. So it
But
should
does
not
that mean
affect-
you ignore it, or does it mean you split it based on profits? And if there are 4 equal partners, how much is the liability? $900,000, right? What's 900 divided by 4? 225. What's their starting basis? 25,000, right? That's what they put in. And now they get to split, just like Mike said, the non-recourse liability in 4 equal shares. Their outside basis is 25 plus 225 or 250 apiece. So their outside tax basis here is $250,000 apiece. You know? You got it?
Yeah.
Authority 752. Go ahead. Just say it loudly.
Can you explain
Fine.
how you arrived at the outside basis?
All right, gotta ask. Angie, do you hear what she's saying?
A little bit, but how did you get that
I'm
tax
asking
basis?
you to explain how do you arrive at the outside basis for each person being 250, given that they borrowed.
Be careful of the word they.
Given that
The partnership borrowed.
which constitutes the 4 members borrowed the money to buy the land, so that would be
The partnership borrowed the money, right, to acquire the property, right?
right.
And that being the case, that liability split based on how they split profits. What's my authority? Code section 752. This is non-recourse. Look at regulation 752-3. You have to look at this. Your Labor Day. Look at this. Okay? Outside tax basis here, 250,000 for your notes. Question B. What resulted the partnership is a limited partnership. A is the sole general partnership, and all the partners share profits and losses equally. Would that change the outcome? And the answer is no, that would not change the outcome. Question C. What results in B above it? The partnership were personally liable for the debts. So now it's recourse. Okay? And in question B, okay, A is the general partner, B, C, and D are the limited partners. So, who bears the economic risk of loss here? Who bears the economic risk of loss in question C? The general. And so, Viva, how would basis be split up here? How would you split up the basis?
What do we have?
How would you split up the basis, guys?
A would be 925,000.
A would have to be 925, right? Here's the economic risk of loss. The other partners do not. B, C, and D would have outside basis of 25,000 apiece, right? So your answer. A has a basis of 925, B, C, and D each have a basis of 25. A has a basis of 925, B, C, and D have a basis of 25 each. Contributions of contributed or encumbered property. Contributions of encumbered property. So the authors are going to walk us through some more code sections and regulatory sites. Now keep in mind, page 51. Everyone see the italics language? It says recourse liabilities in general. Okay? It talks about someone contributing, in this particular sample, A and B are equal partners. Let me just refresh my memory with the fact pattern. A contributes a parcel of land with a fair market value of 150, adjusted basis of 50, encumbered by a $30,000 recourse mortgage. And because he's sharing that with B, he's shedding $15,000 of the liability. Just like in my example with Peter and Ken, if you enter into a partnership and it's recourse liability and other people agree to share the burden, the contributing partner is considered to have received a distribution. Okay? But in this case, because taxpayer A has adequate outside basis, there's no gain or loss to A. Remember, normally distributions do not give rise to gain or loss. But if, for example, Tom has an outside basis of $30,000 and Tom gets a distribution of $40,000, guess what? Tom is going to have to pick $10,000 of gain up, right? If you get a distribution in excess of basis, do you have income, guys? So even though generally partnership distributions do not give rise to gain, if you get a distribution in excess of basis, you do have gain.
If it's cash.
I'm sorry?
If it's cash.
If it's cash. Okay? If it's property, other rules come into play. All right. Now, so that's the general rule. Page 52. Suppose you have liabilities in excess of basis. You relieve the liabilities in excess of basis. If you recall, you may or may not, you remember the Crane decision? Everyone remembers Crane. But do you remember the Tufts decision? Tufts says that if you get liabilities, or if you in Tufts, they walked away from property, they just gave it back to the bank, and the liabilities were in excess of basis, right? Liabilities were higher than the adjusted basis in the property. That gave rise to a gain, right? Because it was considered under Code Section 1001 that if you give up to a bank property subject to liabilities, the liabilities are deemed to be an amount realized, and your basis is less than the amount of the liabilities, you're going to experience a gain, right? You're going to experience a gain, period. In the partnership context, suppose you give up liabilities in excess of your basis. And Michael, to your point, this is considered cash, a cash distribution. You run the risk of recognizing a gain. So that's spelled out on page 52 and page 53. Page 53, 54 talks about non-recourse liabilities in general. And here again, we're going to divvy up non-recourse liabilities based on profitability. But sometimes, just like we had recourse liabilities in excess of basis, sometimes your non-recourse liabilities are going to be in excess of basis. And guess what? That can give rise to a gain. You're going to see some special quirky rules apply, but same sort of result can occur. So let's see if we can get through the problem on page 55, 56, because I know this feels a little rushed, but that's okay, because I want to give you a lot to dwell on over Labor Day. Okay? So I want to keep your plate full. So look at page 55. Let's see if we can handle this. A and B contribute $30,000 cash to ABC partnership. C contributes land held for more than 1 year, worth 60 and subject to a recourse, I have the word recourse in red, of $30,000. A, B, and C are all general partners with a 1/3 interest in the profits and losses of A, B, and C. What are the tax consequences to A, B, and C? And A, B, and C, the partnership, if the land has a basis to C of 40,000, and the partnership assumes the debt. All right, guys, write out a balance sheet, it'll help you. And then we'll talk about the tax implications. Okay, so how much cash is being contributed here? 60, right? Everyone agree? Everyone had that, right? What's the land? To the partnership, it's a $40,000 basis, right? We know that? 60, right? Everyone got that? All right, now, we know the liability is 30. And how is that going to be shared?
1/3 each.
1/3 each?
Yep.
So that means C is shedding 20,000 of liability, right?
Which
It's keeping 10 but shedding 20. So what happens to the tax basis of A and B? Will increase to 40, right?
10,000, yeah.
And C's will go from 40 down to 20, right? And does the liability affect your capital accounts? No. Everyone agrees? C has a net decrease of liabilities of $20,000. And the other two partners are considered to have contributed $10,000 more apiece. Right? Assuming you have that right, what happens if C basis the land were $10,000? Just write out the balance sheet. Take 1 second. See what the results you would get.
C would be 110,000.
I'm just all right. So we know the cash is going to be 60 each, right? Okay, 10, right? 60.
70 and 20.
Now, A and B are going to absorb, right? Their base is going to go up by 10, right? C started off with 10, but he's deemed to have gotten a distribution of 20, right? Can you have negative tax basis, guys? Heck no, right? What happens to their capital accounts? Well, they're still 30.
will have that.
So, for your notes, A will have a $10,000, right, recognition event. Agreed? C, I apologize. C will have a $10,000 recognition event. How could he have avoided this? He could have, C could have contributed $10,000 of cash, right? That would have insulated him from recognizing the gain. He could have remained, just like Peter, Ken, and I, C could have decided to remain liable on the entirety of the note, as opposed to having the partnership become liable on the note. Could C have avoided this result by contributing his own promissory note? And the answer is no. Contributing your own promissory note will not help. For those in corporate tax, there was a case Perochi that it did help, but not in this case. Notice there is a disparity between inside and outside tax bases. Everyone see that disparity? That can happen in partnerships. There's something called a 754 election, which we will learn more about as the semester unfolds. If you have a 754 election, that can reconcile the difference. In the absence of a 754 election, you can't. Okay? That will not, you can't reconcile the difference. All right? So we just got some foreshadowing that will happen. But this was not the best outcome for taxpayer C. Elijah?
Did you explain how C went down to 0?
Well, he started off at 10, but then he's deemed to get $20,000, right? And you can't go into negative numbers. He shed $20,000 for the liability.
But wasn't it 20,000 before?
That's a different.
No, but if you look at the problem, don't go based on this. It's a new fact pattern. Okay? He's deemed to have a $10,000 basis. Okay? Right? Question C. Same as A, except that the debt is non-recourse, and the partners agree that for purposes of allocating the non-recourse liabilities, each have a 1/3 interest in the profits. Will that change the outcome in A? Will that produce or yield the same outcome? The answer is
Non-recourse for who?
non-recourse to the partnership. In other words, the outcome will be the same as in A. For your notes, under Regulation 752-3, the outcome will be the same. Okay, final question. Well, we have a question two, not the penultimate question. Question D. Quick question.
Just a quick question. Could you restate what recourse means?
Recourse means they can go after you personally. Non-recourse means you can't. Question D. Same as B, except that the debt is non-recourse, and the partners agree that for purposes of allocating the non-recourse liabilities, each have a 1/3 interest in the partnership. So now there's a $30,000 debt on the property, and C's basis is $10,000. Okay. So quickly come up with an asset and balance sheet. Okay, we don't have much time, so the cash here is $60,000. Everyone agree? Everyone agree. The land has an adjusted basis of 10, fair market value of 60. Okay, we're good, right? So far. Now, here's the tricky part. Everyone agree that C contributed this property, right? And at the time he contributed, his basis in the property was 10, and the fair market value of the property was 30. Excuse me, let me change that. The liabilities were 30 and his basis were 10. If taxpayer C walked away from this property under the Tufts decision, what gain would taxpayer C have?
20,000.
Everyone agree that taxpayer C would have a minimum gain of 20,000, right? If he just walked away from this property under the Tufts decision, his liability is 30, his basis is 10, he has $20,000 worth of gain. Can he shed that? So if Sola, Peter, and Ken went into this arrangement, and I contributed that property, is there any way for me to shed that $20,000 worth of gain? The answer is no, right? The first $20,000 of this gain has to be allocated to me under the principles for your notes, code section 704C. Under 704C, the first $20,000 gain must be allocated to me. What about the remaining $10,000 of gain? Excuse me, 10,000. We counted for 20 out of the $30,000 of liability, right? What about the remaining 10,000 of liability? Distribute to each partner, right? 1/3, 1/3, 1/3. So, in this case, the first 20 under code section 704C is not shed by taxpayer C. The other $3,333 is shed, so that each one, their basis will go up by 3,333, and then what happens to my basis? It will go down by $6,667 because I'm shedding of that 10,000. The other two partners get a 1/3 interest, and I will have, the taxpayer C will have that. And there will be symmetry here, because taxpayer C will not have to pick up a gain. You're going to have to look at this stuff, and again, you're not going to master this stuff yet because we're going to spend 3 hours plus talking about liabilities. Let me just conclude with problem 2, just to say we did it. On page 56, attorney is a cash method unincorporated sole proprietor or practitioner joins a cash method partnership of 3 other attorneys, all of whom own a 1/4 interest in the partnership. After the attorney joins the firm, attorney transfers some accounts receivable for services with a 0 basis and $20,000 base value as part of her contribution in exchange for a partnership interest. The partnership also assumes $6,000 of the accounts payable. Who gets taxed on the accounts payable and the accounts receivable? So let me just, for your notes, make clear that the attorney who contributes the accounts receivable should get taxed on the receivables. 704C1. He's the one who performed the services, he should get taxed. And here, because the accounts payable are deductible, there's a revenue ruling 88-77. I'll repeat. Revenue ruling 88-77. That says that liability gets ignored. If the liability is deductible, it gets ignored for 752 purposes. If you recall in all the prior problems, was the liability deductible? And the answer is no. But in this case, the liability is deductible, so it gets ignored for 752 purposes. Now listen, guys, we did a lot tonight, so I appreciate your being mentally and physically present tonight. Mark off your calendars. We'll talk more about this next class. Try to keep October 26th, I think, is a Saturday night. You guys know that I try to host an event annually. So just keep that date open. I'll talk more about it. There should be some pizza out there, so if anyone's hungry, either grab it for yourself or grab it for children or significant others who have. Any last minute questions? We're all good. I will see everyone here next Wednesday. Thanks for coming. I will see you again next week.